Hello, class. And today we're going to be talking about Chapter 2, which talks about cost concepts and behaviors. First of all, I'd like to apologize for all the issues that we've been having for the lectures, but I hope that I have found a solution. If you have any questions about this or any comments, please feel free to let me know what you think, and we'll go from there. Now, there are five learning objectives to Chapter 2. We're going to be talking about the basic concept of cost, explain how costs are presented in financial statements, identify the components of the product's cost, understand how material, labor, and overhead costs are added to a product at each day of the production process, and define basic cost behaviors, including fixed variable, semi variable, and step costs. So let's get started here. The first thing we're going to talk about, what is an actual cost? Well, cost is a research sacrifice for or foregone to achieve a specific objective. So basically, it's what how much did you pay for a particular item? We have two types of cost here. We have actual costs, and those are the costs that you incurred, the history. Whereas we also have budgeted costs, and those are what you're predicting to spend. Costs are measured as a monetary amount paid to acquire goods or services. So whenever we're talking about costs, we're really relating it to money and how much did we spend. Now, what is a opportunity cost? Well, basically, what an opportunity cost is the cost of choosing one alternative over another. So, how much did you pay for one thing and what did you give up? So, an example that we can look at in your own personal life is how much would you give up to attend college full time? Well, the one thing that comes to mind is basically you're giving up working full time. So, how much could you learn compared to how much it cost you to go to college? And overall, so you don't want to really look at it just at the beginning. Yes, it might cost you about $10,000 or so a year to go to college, but in the long run, how much did that really cost you compared if you went and started work today? Now, what is an expense? Expense is money spent or cost incurred um, by an organization's effort to generate revenues representing the cost of doing business. So basically, an expense is, the cost of doing business. Now, all expenses are costs, but not all costs are expenses. So one thing that you think about expense, you think about rent expense, you think of utility expense and stuff like that. Now, the one thing that's not a cost, or what is a cost and is never an expense, is land. Now, you think, okay, how is that so? Well, land, it's a permanent asset and it never goes away. We don't depreciate it or anything like that. Everything else, we expense it through depreciation or we expense it by paying for it. So, land is the only cost that we have that is not an expense. Now, how do we present cost on the financial statements? When we're looking at the three different types of companies that we have a service company, a merchandising company, and a manufacturing company. And all three of these type of companies, their costs are calculated differently. Overall, it has the same basic, format, but the different types of costs are different. So in revenues or in service companies, basically it's the cost of the services sold. So I used to work for a garage door company. And so our cost of goods was the actual service tax that we paid, any supplies that they might have used, and any um, you know uh, items that we might have used to fix something or replace something like a garage door opener, or the such. So those are the expenses of our company. We didn't really have a product per se, but we had a service. Now, in a merchandising company, when you think about merchandising companies, you think of things like Walmart, Costco. Kohl's, companies that sell merchandise. And so their cost of goods sold are the products that they actually sell to the public. And so, again, they have the same type of revenues minus cost of goods sold, but their type of cost of goods sold is different. Now, in a manufacturing company, the cost of goods sold consists of really three items: raw materials or materials, work in process, and finished goods. So they have three different types um, of inventory. That's actually all inventory, and they'll roll up into cost of goods sold when the product is finished and sold. And we'll be talking about that later on into this lecture. Now, some useful concepts. Um, Now, the cost objects. What are cost objects? They may be virtually anything. If you look in your book on the top of page 30, you'll see some cost objects in regards to a BMW. Now, the cost object of a product, the product is the BMW X6 sports utility vehicle. So it's the actual product that the company is making. The service for the BMW would be like a customer service line that they might have. The project would be a R&D project, could be the cost object. Uh, in this case, they're talking about the R&D project about the DVD system in the BMWs. The customer now, and BM, in BMW, when you're talking about the customer, you're not actually talking about you and I. You're talking about the dealer, because in reality, we don't buy directly from BMW. We buy through a dealer. So the dealer is the actual customer of BMW. The activity: setting up the machines for production or maintaining production equipment. So the cost objective is any cost associated with the activity of setting up the machines. And then finally, we have the department. So it could be broken up by department: environmental department, health department, and safety department. So those are the different things. Now, in direct cost, when we're talking about direct costs are costs that can easily be traced to a particular object. So for a vehicle, it would be like the tires on the car, or it could be the steering wheel, something that I can physically trace back to a particular unit. Indirect costs are going to be the costs that I can't directly trace to that BMW. So it would be the factory overhead, or the rent on the factory, or the maintenance people, or the people, the supervisors. So anything that we can't trace directly to the vehicle is what we consider a indirect cost. Now, with product costs, we have two different types of product costs. We have the direct material costs and the direct labor costs. So, what are those two things? The direct material costs are the costs that can be directly identified to the product at a reasonable cost. So, it would be the door to the BMW, be the tire to the BMW. When we're talking about manufacturing, if you see the words raw materials, that's also direct materials. Now, direct labor is labor that we can associate directly to a particular item. So it would be the assembly line workers that would be direct labor in this case. Just remember, any direct costs are costs that can be directly traced to the product itself. Now, we have the manufacturing overhead. So, what is manufacturing overhead? It is all production costs other than direct materials and direct labor costs. And so these are the things that is associated with the production of a particular item. So in this case, the BMW, but it is not something that we can tie exactly to that or easily trace it to it. So, some examples: we have three categories of factory overhead. We have direct materials, indirect materials, indirect labor, and other overhead. Now, indirect materials are the things that are basically in bulk. So glue, you can't exactly tell how much glue you use for each product, how many nails, staples, cleaning supplies for the productions facility. Something that is in bulk and we might use a little bit here, a little bit there. We can't easily uh, tie it to a particular vehicle. Now, in the indirect labor, that's kind of like the overhead, the supervisors, the inspectors, the security guard, the janitor of the building, and any overtime labor is also considered indirect because with overtime labor, we can't really tell which vehicle it went to and when it did. So that's why it is considered overtime labor is indirect labor. So anything that is not directly working on the product itself is indirect labor. Anything working on the product itself is direct labor. Now, other overhead is basically in regards to anything dealing with the building or the general line itself. So in this case, it would be factory insurance, the rent, the utilities, the depreciation, electricity, things like that. Something, again, you can't directly tie to a particular item. So now let's take a look at this class project here, practice problem. Best Breads manufactures breads. The cost in the process of making the bread are listed below. If a cost object is the bread, please indicate if the item is listed below is a direct material, direct labor, or manufacturing overhead. If it's manufacturing overhead, we need to label it direct materials, indirect labor, or other. So the first one is yeast. What is that? Well, what does yeast do? It goes directly into the to the bread, so that is considered direct material. Flour, well, that's the same thing. Flour is something that we put into the bread, so it is considered direct material. Depreciation of ovens. Well, that's associated with the bread, yes, but it's not directly. We can't tie it to a particular piece of bread. So that would be manufacturing overhead. Now, what does depreciation entails? Well, it's not labor and it's not material, so it will have to be other. Same thing with depreciation of mixing machines. It's not direct material or labor, and it's not indirect material or labor, so it has to be overhead. Overhead other. Rent on the factory material. Well, that's not neither labor or material, so it has to be manufacturing overhead. Now, it's not involving material or labor at all, so again, that is going to be other. Fire insurance on the factory building. Again, that's not involving anything related to the actual product itself, and it's neither labor or materials, so it has to be manufacturing overhead other. Factory utilities, again, that is dealing with the building itself, so it has to be manufacturing overhead other. Finishing department hourly laborers. Well, that is actually dealing with the product itself. Yes, it is. And it's the finishing department. So that would be direct labor. The mixing department labor. Okay, so this is dealing with paying of someone money to produce this product. But because he's a manager, he could be over several different labor departments. So, or mixing department like manager. So this is actually manufacturing overhead, but it is indirect labor. Custodian of the factory, same type of thing. It's overhead because it's not tied to a particular item. So it's going to be manufacturing overhead, direct labor. The night guard, same thing. It's not to the particular item itself. And so it has to be manufacturing overhead. And because it's dealing with a person paying a person, it's labor. Machinist, running the mixing machine. So they're actually doing the product. So that is direct labor. Machine maintenance personnel, well, we can't really tie them to a particular item or something. So it's going to be manufacturing overhead. And because it is the machine maintenance personnel, it's a person. So it will have to be indirect labor. Maintenance supply, again, is not dealing with making the actual bread. It's supplies used in and upkeep of the production line. So that has to be manufacturing overhead, and it has to be other because it's neither materials for the product or it is neither um, materials for the product or the supplies for the labor for the product. Now we have cleaning supplies. Again, that's going to be manufacturing overhead, other. And quality control. That's going to be manufacturing overhead. But quality control would be a person, so that's indirect labor. Okay. All right. So I hope you get a better understanding what manufacturing overhead, direct labor, and indirect labor is, and direct materials and indirect materials. Now, when we're talking about the categories of cost, we have prime cost and product cost. Now, with prime cost, we have direct materials and direct labor. So when you're asked, what are the prime costs? You're going to talk about your direct materials, direct labor. All direct manufacturing costs is another way to think of this. Now, the conversion costs are all manufacturing costs other than direct materials into the item. So those include your direct labor and your manufacturing overhead. Now, other considers are including the non-manufacturing costs are what we call period costs. And period costs include advertising, promotion, warehousing, customer service, any of the administrative. So if you see office, administrative office, you automatically know those are period costs. Now, when and where are the product period costs and product costs recorded? So let's talk about product costs first. Again, product costs are going to be the direct materials, the direct labor, and the manufacturing overhead costs that are attached to a product when it is produced. Now, when we first record the product costs, they're going to be recorded as an asset on your books. So they're either going to be raw materials, work in process, or they're going to be finished goods. And they are going to be an inventory on the balance sheet. And then once we sell the product, they're going to move from finished goods to cost of goods sold. Therefore, they'll become an expense on the income statement. Now, a period costs are all your non-manufacturing costs. So typically, they're going to be your selling and administrative costs. And basically, they're expensed when occurred or paid, and they always will be on the income statement. That's the only place you'll find those. So now, let's look at another example. So when I first did this particular problem, the first thing I did was I went through each one of these and I decided, okay, which one is a product cost and which one's a period cost. So let's go through this right now. The first one is going to be labor of the saw operators and the upholsters. Well, writing now that says saw operators or posters, that's talking about the product itself. So that is actually PU, product. The print and television advertising. Whenever you see this, you automatically think, okay, that has nothing to do with the making of the product. So that has to be a period cost. Labor or product quality control. So you see the words product there, you automatically think that's the product cost. Thread, glue, sandpaper, etc. Again, that's all dealing with the actual product, so that has to be a product cost. The labor of the sales staff. Well, sales staff has nothing to do with the actual making of the product, so we know that has to be a period cost. Utilities of administrative offices. Now, the key there is administrative offices. If it said of production facility, then it would be a product cost. Because it says administrative offices, we immediately know that it is a period cost. Now, with this labor of software assemblers, so this is someone that is working on the product itself, so we know immediately that is a product cost. Factory rent. Well, as soon as you see the word factory, you automatically assume that that is a product cost. Next one is depreciation. Now, the depreciation is based on what it's depreciating. In this very first problem, it's depreciating saws, drills, and sanders, which is used in the making of the product, so it has to be a product cost. But the next one is the depreciation of office and office equipment. So immediately, since that has nothing to do with the product itself, we know that that is going to be a period cost. The sales commission, well, you see the word sales. As soon as you see that, you automatically assume that that is a product cost, a period cost, I'm sorry. Now, again, we have factory security and maintenance wages. So as soon as you see the factory security, you know that's related to the product. The next one is human resources. This has nothing to do with the actual making of the product, so we know that is a period cost. Insurance factory. As soon as you see the word factory involved in insurance, you know that is a product cost. Lumber, springs, and upholsteries for sofa. Well, that involved the actual making of the product, so of course that's going to be a product cost. Now here we have the insurance, and it says administrative offices. As soon as you see the word administrative offices, you know that that's a period cost. It has nothing to do with the actual making of the product. And then factory gas and electric. Well, as soon as you see the word factory there, you know that that's a product cost. Now, let's talk about the questions that they ask. Well, here it says, what are the total prime costs? Well, the total prime costs, if we go back into our list here, the prime costs, remember what are those? Those are the direct labor and the direct materials, and they deal with the product costs. So if we look here, product number 1, which is labor, saw, operators, and upholsters, is going to be one of our product costs. So that's $25,000. And then we have, if we keep on going down until we get to labor sofa assemblers, that is going to be a direct labor cost. So that's part of that. And then finally, we have one more, which is the lumber, the springs, and upholstery for the sofas. And so that is considered direct materials of 50,000. So if we add those up, we get 101,000. Okay. Now we're talking about the overhead. So basically any other product that we have here is going to be an overhead, and we have to divide this into the various indirect materials, indirect labor, and the other overhead. So the first thing we're going to look is direct materials. And we go down the list, there's really only one, and that's going to be the thread, glue, and sandpaper. And so that's number 4, and that's at 2,500. The direct labor, well, we have two of those. We have the labor product quality control at $10,000. And we have the labor security and maintenance wages at $4,000. So the total of indirect labor is $14,000. Now the overhead, the other manufacturing overhead, we have several of those. The first one is the factory rent at $2,000. We have the depreciation of the saws at $5,000. We have the insurance for the factory of $2,000. And finally, we have the factory gas at $5,000. And so if I add those up, I get $14,000. So my total manufacturing overhead is the 2,500 plus the 14,000 plus the 14,000, and that equals 30,500. Now, what are my conversion costs? Now remember, what are conversion costs? Conversion costs are my direct labor and my manufacturing overhead. So what was my direct labor? So my direct labor was the $2,600 from the sofa assemblies and the $2,500 from the saw operators. So I have 25 plus the 26. And then I take the manufacturing overhead that I got from above of 30,500. And so my total conversion costs are 81,500. So what is my total product cost? So if I add up the direct labor, the indirect labor, or the direct labor, the direct materials, and the overhead costs, I'm going to get the 101 plus the 30,500, and that's going to give me the 131,500. Now it asks us, what are the product costs per unit produced? Well, if I have 131,500, I made 5,000 units. So if you go up here, it says we made 5,000 units. And so that equals $26.30. Now, how much is my per unit sold? Well, it is the $26.30, but we also have to consider the product cost, the period cost that we didn't hear. Now, if we add up all our period costs, that's $50,000. And if I divide that by the $2,000 that we have sold, or 2,000 units we sold, I get $25 per unit. Okay, so if I add that to the product costs, I'm going to get a total of $51.30 per unit. And again, one of my total period expenses are $50,000. All right. So now let's get into the actual direct materials, or I'm sorry, raw materials, work in process, and finished goods. Now, when I'm talking to students face to face, one of the things I talk to them about, imagine 3 different rooms in a manufacturing facility. The first room would be when the materials come to the factory and they're put into the first room. And then from there, they're requisitioned from the manufacturing floor. So we pull it out of the raw material room and put it into the manufacturing room. It goes through all the processes there, and then we take it out of the manufacturing room and put it into the finished goods room. So how do we figure out each one of those items or how much is in there? Well, the first thing we have is the beginning balance. So if it's a brand new company, of course, we're going to have nothing in there. But from the first month to the second month, the ending balance from the first month becomes the beginning balance of the second month. So when you're talking about the raw materials, you're going to have the beginning balance. You're going to add anything that you purchased and put into that room. You're going to subtract anything you take out of that room and put it in work in process, and that will give you your ending balance in the raw material room. Now, in the work in process, you have several additions to that particular room. You have the beginning balance, what was there at the beginning of the month. Then you add any of the direct materials that were put into the room. So basically, from the raw material room that transfer to work in process, that is the actual direct materials that's in work in process. Then you add in the labor that you had for that particular item, and then the manufacturing overhead. You add those to the beginning balance and you back out the cost of goods manufactured. And the cost of goods manufactured is the amount that you take out of the work in process room and you put into the finished goods room. Now, this ending balance here, that's the beginning balance plus the materials, plus the labor, plus the overhead, minus what you take out. That's my ending balance. Now, in the finished goods room, we have what was there at the beginning of the month. And then this number right here from the cost of goods manufacturer, that goes added to the finished goods. And then you subtract what you take out to give to the customers. And that equals your ending balance. So think of it as, picture it, if that helps you, if you're a visual person, think of it, you're taking it from one room, putting it in the next, and then putting it in the next. Now, if you want to see the T account part of this, basically your debit raw materials for the beginning balance, what's in there. You'll debit it for any purchases. You'll credit it. Basically, you'll have a credit to raw materials for any of the items that you put in work in process. So then when you do that journal entry, the debit side to that journal entry is going to be work in process inventory. So here you have the beginning inventory, you add in any direct materials, and then you add in the direct labor. So you would debit wages expense, or debit work in process inventory here, and credit cash, or credit wages payable. And then you add also your manufacturing overhead, and you subtract your cost of goods manufactured. So whatever, that's the credit. And then the debit side, of course, is going to be the finished goods inventory. And then when you take it out of finished goods, you're going to credit finished goods and you're going to debit cost of goods sold. So what are the definitions? The raw materials inventory is the raw materials ordered but not yet put into production. So that is what is in the raw materials room. What is the product in the production process but not yet complete? Well, that's work in process inventory. And then what are the products fully completed but not yet sold? Those are the items that are in finished goods inventory. Now let's look at an example. One of the easiest ways that I have done these is I set up a chart just like this. Anytime I'm doing these type of problems, I'm going to set up one of these charts. And then I'm going to fill in the blanks for everything that I have. So the first thing that I have here is finished goods inventory for March 31st. Well, that's the end of the month. So I'm going to go right here and I'm going to type in $29,000. The next one is the direct material purchases. Well, direct material is another word for raw materials. So I'm just going to put that right here, and that's $70,000. Okay. Now, the next one down, if you look up here, it's $21,000 for indirect labor. So indirect labor is actually manufacturing overhead. So let's go ahead and just take care of that. So when we're looking at the manufacturing overhead, we are going to have indirect labor. We're going to have the factory supervisors, that's indirect labor. We're going to have the factory utilities expense, which is indirect other. I'm sorry, the overhead other. And we have the factory depreciation expense. That's going to be overhead too. Now, if I add 21,000, 12,400, 4,000, 5,000 together, I'm going to get $4,200. 42,000, I'm sorry. Now, so we took care of those. The next one is the direct labor. So that amount is $48,000. So I'm going to put that here. The work in process inventory at the end of the month. So right here, I'm going to have $73,000. Now, let's go. We already took care of the factory supervisors. Direct material inventory at the beginning of the month was $12,000. And then we took care of the factory utilities expense. Direct material inventory at the end of the month was $21,000. Okay. Work in process inventory at the beginning of the month was $54,000. So I'm going to go right here. We already took care of the factory depreciation expense. We have finished goods inventory as of the first of the month. So we go right here for the finished goods inventory, and that's $33,000. All right. So now let's take a look at what we have to fill in. Well, the very first thing is pretty easy. We're going to have to deal with the raw materials. Now, remember, beginning plus, plus purchases minus 2 work in process equals the ending. So in this case, I have 12,000 plus 70,000 minus X, we're just doing a basic algebra class question here, equals 21,000. Now, moving these around, we have basically X will equal 12,000 plus 70,000 minus 21,000. So if I add those together, I get X equals 61,000. 12 plus 70 is 82, minus 21 is 61. So work in process is 61,000. So if we go in here, that is actually the direct material number. So I can fill in this part of it. So now, if you notice, now in work in process, we only have one missing. So if we look in work in process here, what is work in process? That's beginning plus the direct materials plus the direct labor plus the manufacturing overhead minus the cost of manufactured goods equals the ending. So here we have 54,000 plus 61,000 plus 48,000 plus 42,000 minus X, because we don't know that one number yet, equals 73,000. Now moving these around, I'm going to have X equals 54,000 plus 61,000 plus 48,000 plus 42,000 minus 73,000. And if I add all those together, I get X equals 132,000. So if I go up here, I have 132,000 as my cost of manufactured goods. So I can take that number over to my finished goods. I have 132. Now, if I look at this particular formula, I have beginning plus cost of manufacturing goods, minus cost of goods sold will equal my ending. So in this case, I have 33,000 in my beginning. My cost of manufacturing goods is 132,000. I don't know what my cost of manufacturing goods sold is, but my ending is 29,000. So if I move these things around, I have X equals 33,000 plus the 132 minus the 29,000. So my cost of goods sold is $136,000. All right. So I hope that helped you in regards to figuring out how to calculate that. We're going to be doing another example here in a few minutes. All right, so moving on to the next item is define the basic cost behaviors, including fixed, variable, semi-variable, and step basis or step costs. Now, so what are the difference between fixed and variable? Fixed costs are costs that no matter what you do, that's going to be the amount that you pay. Nothing will change it. So you have a fixed cost. Now, the variable costs are based on how much you produce or how much you do will change the price of the item. Semi-variable is going to be talking about some of it, part of it is going to be fixed and part of it is going to be variable. And step cost is basically you have a range of items or a range of things you can do. And then once you get to a certain point, your cost steps up. So relevant range refers to the activity level within which a given total fixed cost or unit variable cost will be unchanged. So if you look in your book, they give an example of a truck, and they talk about the two trucks. It's on page 35. And basically what it says is this particular truck can go 120,000 miles. So our fixed cost for each truck is $40,000, no matter what. So I can use one truck up to 120,000 miles. That's my relevant range for one truck. Now, if I go over 120,000 miles, that means that I have to get a second truck. And so my cost goes from 40,000 up to 80,000. And so in this case, the relevant range for two trucks is between 120,000 miles and 240 because each truck has 120,000 miles that it can use. Now, fixed costs are costs that are unchanged as volume changes within the relevant range. Activities. Examples are rent, depreciation, insurance, and salaries. Those are the items that no matter how much you produce, the amount is going to stay the same. Now, variable costs are costs that change in direct proportion with a change in volume within the relevant range of activities. Examples of this is manufacturing companies, the direct materials, certain manufacturing overhead, direct labor, and such. So, based on the number of products you produce, the costs are going to go up. Now, why is gasoline a variable cost? Well, no matter what, if you look at it this way, if I put $20 in my gas tank, I am going to get 20 times the cost per gallon, or divide that 20 by the cost per gallon, and that's how many gallons I get. So if I get 1 gallon, it's going to cost me, say, $2.21 in this example. Now, if I get 2 gallons, it's going to cost me $4.42. So it's based on the gallons I produce is how much my total cost is going to be. Now, a way to remember how they change here, for total cost and variable, it changes. The variable cost changes as the number of products change. The cost per unit will stay the same. So remember, variable cost, it changes, the total cost changes as the number of products produced changes, but the cost per unit will stay the same no matter what. Now on fixed cost, your fixed costs will not change. So the total cost will be the same no matter how many products you produce, whereas the cost per unit will go down the more products that you produce. So here, what is the answer here? A semi-variable cost is a cost that has both fixed and variable components. It's also called a mixed cost. So the easiest example I have told my students about is the U-Haul. If you ever seen a U-Haul, I don't know how it is now, but before you had the words like 1995 on the U-Haul. And so that would be the fixed cost. So no matter what, you have to pay $19.95 just to get the U-Haul. And then they charge you a price per minute, say 45 cents per mile, I'm sorry. And so the fixed cost portion would be the $19.95, and then the variable cost portion would be the 45 cents per unit, or 45 cents per mile. Now, a semi-fixed cost, the cost that increases with volume and steps. And we talked a little bit about that earlier with the two trucks. With one truck, the cost is 40,000, and I can drive that truck up to 120,000 miles. And then once I go over 120,000 miles, I have to get a second truck, and then the cost jumps to 80,000. So each truck is 40,000, and I have a range between 0 and 240 for the two trucks. Now, here's an example talking about the cost behavior. So what we need to do, first of all, is determine what the cost per unit is for the variable cost. Now, how do I do that? Well, I have $8,000 in variable cost. I have 1,000 units. So I'm going to say 8,000 divided by 1,000, and that equals $8 per unit. Now, my fixed cost is going to be $30,000 no matter what. So I'm going to take the 30,000, divide by the 1,000, and that is $30 per unit. So my total cost per unit is the 30 plus the 8, which equals $38. Now, how does that change with 2,000 units? Well, again, the variable cost is based on the number of units. We earlier calculated that the variable cost per unit is $8. So I'm going to take the 2,000 units, multiply it by 8, and that is going to be 16,000 unit or $16,000. Well, the fixed costs are what they are, so that always is going to be $30,000. So if I add those two numbers together, I'm going to get $46,000. So the total cost will go up just because the variable cost went up. Now, the variable cost will stay the same. That will be $8,000 no matter what. But the variable cost, the fixed cost per unit is going to change. How do I know that? Well, I still have the 30,000, but this time I divide it by 2,000, and that equals 30,000 divided by 2,000 is $15 per unit. So now, because I have 15 plus the 8, that equals $23 per unit. So as you see, the more products we produce, the cost of per unit will go down. Now, in the 15,000 units, again, I have $8 per unit. So I'm going to take the 15,000, multiply it by 8, and that gives me 120,000. So that went up. But again, the fixed costs are what they are, so that's 30,000. If I add those two numbers together, I get 150,000. Now the variable cost, again, that change stays the same at $8 per unit. Now my fixed cost, I'm going to take the 30,000, divide it by the 15,000, and that gives me $2 per unit. And then for the total cost, I'm going to take the 50,000, 150,000 divided by 15,000, and that's going to give me $10 per unit. Or I can just go 8 plus 2 equals the 10. Okay? So as you can see here, as the units went up, yes, my total costs went up, but my cost per unit went down. Now, we talked a very little bit about at the very beginning about the opportunity cost. And basically, what the opportunity cost is what you gave up between the two options. So, in this case, a developer plans to buy a parcel of land and construct an office building on top of it. He narrows his search to 4 possible lots in adjacent states with convenient access to highway. The expected returns from the lots are 120, 190, 160, and 210 respectively. The developer chooses to buy lot D in hope of realizing the highest return from the money. What is the opportunity cost? Well, basically, it's the difference between each one. So the return on, or the expected returns, the opportunity cost is the difference between 120 and 210, 190 and 210, 160 and 210 are the 3 different opportunity costs there. Now, go into this example. This is just like the previous example we did earlier tonight. And so what I did with this one, again, I put together a chart. So let's go to my chart that I did. So in here, all I did was set up just exactly like we had in the previous one. And in reality, we only have to do the finished goods, but let's go through the whole thing. So the very first thing I did was I filled in what I knew. So in work in process, I know the beginning was $300. I know the end is $700. In finished goods, I know my beginning is $400. I know my ending is $900. And materials, I know my beginning is $500 and my ending is $1,500. Okay? Now, purchases of materials net, Well, that's 7,700. So I go materials, purchases, 7,700. My cost of goods sold is 15,600. And my manufacturing overhead is 4,300. Okay. So let's go to work in process. What do we know about the working process? It's beginning plus purchases minus work in process equals the $1,500. So how do I do that? So that really is, if we do this like this, we're going to say the 900, I'm sorry, not the 900, the 1,500 minus the 500 minus the 7,700. I'm sorry, I got that backwards. Let's do this that way. We have 500 plus the 7,700 minus the working process equals the 1,500. Okay, so how do I figure this out? I'm going to add the 500 together. I'm going to add the 500 and the 7,700, and I'm going to subtract the 1,500, and that gives me 6,700. And so that's direct material, 6,700. Okay. Now the cost of goods manufacturing. What do I know about that? Well, that's 500 plus the X, the cost of goods manufacturing, minus the 15,600, and that equals 900. Okay. So how do I figure that? I'm going to take the 900 minus the 400 plus the 15,600, and I get $16,100. That goes over here, 16,100. Okay. So now, how do I find the direct labor that I'm missing? Well, I know it's the 300 plus the 67 plus the X plus the 4,300 minus the cost of goods manufacturers equals the 700. Okay. So how do I figure that one out? I'm going to take the 700 minus the 300 minus the 6,700 minus the 43 plus the 16,110, and I get 5,500. So now the question that they ask us, what is the goods available for sale? And right here we have 16,100. And so that's my answer, C, in this particular one. All right, so I hope that you guys understood everything that we talked about. If you have any questions about this, please do not hesitate to ask. Again, I apologize for all the issues that we've been having. I will be getting up chapter 3 here shortly. Again, if you have any questions, do not hesitate to ask. Thank you and have a great night.